After such a strong day yesterday and good breakout patterns, especially on these large cap and the S&P 500 and large cap tech names, there's an today we followed through with another good bullish day, but there wasn't much of follow through. It was a very small range. It was very low volume, relatively speaking, to what we've seen here recently. And there's some underlying technical trends I want to take a look at that kind of give us an idea of that should, whether or not we're going to continue to be strongly bullish as this bounce and breakout and gap yesterday would suggest, or are we going to fill in this gap by the end of this week? Right, that's the big question. So we're going to look at some charts to see, and we're going to kind of see, especially when we get into what's driving the market. What is driving this bullishness over the last couple of days, and is it lasting? Is it got potential to last? Is it broad? Is it, or is the main drivers already kind of parabolic themselves? So we're going to take a look at that. And then for our trade idea of the day, it's a very common pattern. It was a pattern we looked at on Monday. It's another good opportunity for the same pattern today. So we'll talk about that for our trade idea. So let's go ahead and get started. Today is Wednesday, December the 8th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the nice little move higher, a very small range, about half the average. Remember, the average has really been inflated because of this the large candle we've been having lately. But a very small range nonetheless, as you'll see here in a little bit. So kind of interesting that we followed up a kind of a breakout day with really below average day. But the nice thing about that is at least the small range stayed at the upper end of yesterday's range, and for that matter, above yesterday's range, slightly above yesterday's range. So that kept the near-term line up here in the 90th percentile still. So yesterday we didn't quite finish above the 90th, but today for sure we did, 97th percentile. So that's a very good sign for a new intermediate rally, with the intermediate line climbing out of bearish territory back into the neutral zone, expected, as it does, to get into bullish territory here, especially with the strong near-term move. So we'll see how that plays out over the next little bit. If you take a look at the Dow Jones Industrial Average, you can see that it's got a very similar move, the intermediate line out of bearish territory now. Back above the moving average, 0.25%. Strong near-term rally up to the 93rd percentile. Light pink shading, yellow line. So good sign from that perspective. Of course, the NASDAQ never did really, we never did get a red line and dark pink shading. We never did get the intermediate line into bearish territory. So by definition, the NASDAQ never did have an intermediate pullback. It was just a really deep, we did drop below the 23% line. We actually did drop below the 38% line, but it was so quick that it wasn't enough to produce, an intermediate decline, because we bounced, not only did we drop so quick, but we bounced up so quick, already back above the 23% line, already back to dark green shading and a green line, just like that. And then a very strong near-term rally. So again, almost as if we never actually had an intermediate decline. That's not the case for the Russell. The Russell did have an intermediate decline. We have plenty of dark pink shading and red lines here. The intermediate line's rising, and it's out of the reversal zone, but it's still in bearish territory, still in the pink. And the near-term line is just barely above 90. So it's above 90, so it's a good sign for what may be a return back up to bullishness for the Russell. That kind of follows suit with what we're seeing with the other major indexes. So the strong, the intermediate, bullish intermediate posture is still very weak, weakest on the Russell. But, it's strengthening on especially these large cap names. With the strong near-term run, it would suggest that we should get a pretty decent near-term rally out of it. Again, the typical is 1 to 3 months. So I have a feeling this one probably won't even get to the 1 month mark, and we'll talk about some ideas why for that. But at least right now, the market forecast is suggesting, and this is kind of what I would expect too, that we should get a good strong near-term run here. That our next near-term low point, because we talked about, it's really important to see where the next near-term high is, to whether or not we're going to actually stay bearish. Well, the next near-term high ended up being a very bullish near-term high. So now the next near-term low, which you would expect to also be a bullish near-term low. So one that maybe dips its toe below 40, but doesn't get to really oversold levels, doesn't stay below 50 for very long, and bounces back up. I mean, that's a bullish near-term low, higher than this low point on the price. That's kind of what you would expect to see, and we might not even see for probably another week or so. Would be the expected near-term run. So that's kind of what I'm looking for. So we'll see. Of course, Friday's inflation report could really throw a wrench into all of that, and as well as some other factors. And we'll take a look at some of these other charts here in just a second. Let's go through our routine here. You can see we did have a bearish candle, slightly bearish. We did have a small upper shadow last week, but we're back to a green line. We're back to a positive differential on the Hakunashi, so which means an open candle here. And we have a rising PPO again. So just like that, no intermediate decline. I mean, that was about the fastest 1 week intermediate decline you probably have ever seen. And just like that, it's erased. Now, the week's not over with, so that, we'll see how we finish the week there. And if you look at the Russell 2000, it still doesn't have the green line. And it still has the falling PPO and still has a negative differential. And you still don't have an upper, well, you have a smidgen of an upper shadow. So we'll see how that plays out. Going into the rest of this week here. You take a look at the 3 green arrow chart. You are back to green shading on the diamonds, and getting pretty close to green shading on the Qs. You're missing a green arrow on the MACD by that much. So you're back to green shading on the S&P as well. So 3 green arrows in the S&P 500, and not quite there on the IWM. So at least you don't have the pink shading anymore. So we'll see if this plays into some more green shading, right? Sometimes you might get a day or two of green shading and then roll back over. So it's really important that on these days that we're getting the 3 green arrows, that we don't come right back down below the moving average tomorrow. So we need to hold this 3 green arrow breakout. You take a look at the 2-line version of this chart, and you can see there's probably a pretty good chance. I mean, we got above the 17. We've held above the 17. The MACD appears to be on a bullish divergence now. The lack of volume is a little concerning, all the way back down to 72 million, but still a good sign. IWM, not so good of a sign. I mean, we did close above the 200-day moving average. We didn't yesterday, but we did today. We also closed above the 17-day exponential moving average today. So that's a good sign. But you notice that's not really like that kind of breakout doesn't really make you feel too confident about a bullish move. We are above the point of control. That's good. But you notice we also closed below yesterday's high on the Russell. So again, it's kind of like, okay, here we are, good bullish break, and we slow down today. So we're going to continue this break tomorrow. Really get above the 17 on the IWM, get above the 50 maybe, get above this volume, feel much better about life, or are we going to fill in this gap from yesterday? Which is still a possibility and something we need to kind of be aware. I think that's the lower probability, but it's a probability we need to be aware of. Because if it does happen, it will happen tomorrow and Friday, right? It will happen by the end of this week. Because if this is a runaway gap, it won't get filled. If it's not if it's a common gap, it should get filled relatively quickly. Let's take a look at the other oscillators on this. So SPX. We are back in the bullish territory, but not really strong bullish levels. At least we're not below the midpoint of the chart. Not the case for the Russell 2000. We are flirting with the midpoint. So again, are we going to break through into the other half? Or are we going to kind of hold here, and stay in bearish territory in the lower halves of these charts? Your directional movement index shows an interesting pattern as well. SPY. We are below 25 on the negative indicator and above 20 on the positive. So the bearish move is done. But we don't have a bullish breakout move either, right? So which means you would need the negative. The negative is already below 20, but the positive would have to get above 30. And you notice we're not anywhere close to that. With the Qs, we're a little bit closer. You're just below 25, but still not there. And then IWM, you can see we're not done with the bearish move, right? The positive indicator's got to get above 20. With the negative falling below 25, and that hasn't happened. So the bearish move is actually still in force. It's still not done yet. And if you take a look at like the trend strength indicators, you were yesterday. That was a great bullish move, above 1, above 50. It looked like we were okay, right back to a bullish trend, weak trend, but it looks like maybe a day or two away from an intermediate. and then boom, back to zero today because it's such a small range. We didn't, you typically don't follow through with a big breakout move with a extremely small range and then lower volume. And here's IWM. IWM still, it's not in the mature bearish trend anymore, but you notice it's still in an intermediate level trend, bearish trend. Because you're still below minus 2.5, you're still above 50, so you're still in, and you're still actually in the cloud. So we still didn't even get out of the cloud here. And the red line, which is the current price marked 26 days previous, is actually still below the price from 26 days ago. So we're still lower than we were 26 days ago. So we're still in kind of a bearish posture here. It's not as bearish as it was, but it's kind of still a bounce back. It's just a bounce in a bearish trend so far. Depending upon however you draw your trend lines, if you draw your trend lines coming across these highs as best as you can, you're still kind of at that high point. However you end up drawing it, right? Whatever. It's obviously a artistic thing, but you can see for the general purpose, you're pretty much still at that trend line. So we haven't really busted through to the other side, and you can also see that in the Bollinger Band. So you're at the top of the value area. You're in the upper quartile in SPY. That's great. Very, good bullish sign. But for IWM, you're still barely at the midpoint, right? You are above the point of control, but you're still at the midpoint of the bandwidth. Not quite breaking into that upper bullish half yet, like the S&P. So the S&P looks good, maybe too good. But the IWM is not following suit. So it really puts a lot of, especially with how small today's range was. Here, let me finish with these charts. If you see, like that has all the potential in the world of being a runaway gap. It was a significant gap to the upside. We ran away from the open. We finished up about a couple percent, I think, by the time all was said and done. Did we finish up a couple percent here? Yeah, we finished up over 2%. So it has all the makings of a runaway gap, one that does not fill. But you also notice that we didn't follow through with that today, and we barely got above yesterday's high and closed above yesterday's high. And like I said, that was not the case for IWM. We closed at yesterday's high, but not above it. And we definitely didn't close above last week's high, which is still there. And like I said, that gap is still within range, right? It's still easily within range of being traded in. So we're not done, right? We're not done with the bearishness, and there's that trend line. And we're kind of at this inflection point of, do we break through and finish the week strong with that inflation figure coming on Friday? Or, did we get the strength? Did we pull something forward? Did we get the strength? Was this just a very oversold technical bounce? And then we fill in that gap. I think that's, the lower probability. I lean towards us kind of breaking through here, this resistance, and getting up by the end of the week. But I don't think that's a really dominant. I think there's a very good probability. It's still low, but like not minuscule probability that we come down. And so that's something I'm very going to be aware of here over the next day or two, as I still lean more towards the continuing the upside momentum because of the strong rally in the S&P. Let's take a look at the volatility index, and this is kind of interesting too. And I've been pointing to you about the skew index. The skew has remained very high. See, it's been updated so far. So look at all these consecutive days that were above 150, which means the market is still pricing in a tremendous, a high probability of a tail risk event, of a kind of a black swan event. Of course, they were really doing that over the summer, and we didn't really get very much of one. And then they priced it out as we did get the weakness. Well, we got this weakness. It didn't price it out. That's what typically happens when you get weakness, is it prices out the tail risk because you're experiencing most of the volatility. But we've experienced quite a bit of volatility here. We didn't price out the tail risk. In fact, the tail risk actually remains pretty high. And while the VIX dropped, down below 85%, dropped down to 20, there's some support here. So again, an opportunity for the VIX to bounce from here. And go up. If not, we're breaking below 20. We're breaking below, into the lower half of this range, maybe flirting with 80. And, we're going to be nice and quiet. And the skew will probably stay high. But, it's interesting that, all this weakness here, and it didn't really push the market to say, okay, we've had our tail risk event. The market's actually still very concerned about that tail risk event. And then you look at the volume, and partly you partly see some of that with today's move. Again, very small range, 3 points, and 72 million shares trading hands. So when you put those numbers in context, 3 points is way down here at the bottom end of the 52-week range for the ATR. So well below the average. When the VIX is at 20, you do not expect that small of a range, right? The VIX implies bigger ranges. That's why we've been getting bigger ranges. You don't expect, when the VIX is as high as it is, to not only get small results. I mean, it's one thing to get a small result, but to get a small result within a very small range. And then you look at the volume today as well, and what did I say? 72 million shares trading hands. So here we go. 72 million is way down here too. So again, not your typical, the last intermediate rally, the real one, the volume got all the way up to 100 million shares on average. And before that, in March, we were well above 100 million shares on average. And then you go back to, last September when we got that intermediate decline, we were near 100 million shares. We're only at 80 million shares, and we're already down below that on average. So it makes you wonder if the market's not really as keen on this rally yesterday, because there wasn't a lot of follow-through with that rally here today. So to summarize, it's a good bullish candle. There's some good bullish short-term sentiment. It's really important to see how long this short-term sentiment lasts. It should last a while. It should be a good 7 to 10 month rally. Go through next week. Go through options expiration, and really solidify this new intermediate run. If it can't do that, if for whatever reason within the next day or two we fill in yesterday's gap, then we're still bearish. Right? In fact, we haven't been bearish yet on the NASDAQ and the S&P, and we're still bearish on the Russell. There's still some volatility left to experience. So it's really important how we finish this week, because we need to solidify what we've seen going into the end of December expiration, and then going into the holidays, which is typically a bullish time of year, and then the new year. The beginning of January, which is also typically a bullish time of year, before things volatility can pick up there. So really, really important couple of days, and we got the big catalyst at the end of the week that has in the recent past influenced the markets and volatility. So we'll definitely keep our eyes on. What do you think? Do you agree with that? What we've been talking about here? Do you disagree? Let me know in the comment section, especially if you disagree. Let me know what charts or indicators you're looking at that would tell you why you're either a lot more bearish than I am or a lot more bullish than I am. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us, number one, you liked the video today. Number two, you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like our stuff, you don't have to click on anything. Also, join our comment on anything that stood out to you. What questions or comments you have about anything I talk about, put that down in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us here on our blog, check out some of these other things over here on the right. Click on this icon. That takes you to this Market Outlook live page. Monday, Wednesday, and Fridays when I do the Market Outlook, I also do this live video at 3:30 Eastern Time on this page. I review all the trades from old Market Outlook videos. I also put on today's trade before the market closes. You can catch it live here. You can see all the archives also posted here. There's also a chat that's usually available during the live event with other viewers. If you come, you can also find it too if you come over here and click on Live Trade Review in the Market Outlook category. Also, you can see our upcoming classes. Click on View More. That takes you to our calendar with all of our upcoming classes, as well as 3 years worth of recordings. You can also get to this by just clicking on Trading Rooms right here. Come down to the bottom, hit that heart. It opens up a new tab. Hit that like button. Also click on this thumbs up icon. Takes you to this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers. It also benefits you because Twitter and Facebook promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. All right, now let's take a look at our different levels of risk appetite, right? Remember, our three biggest risk appetite trades right now are commodities, small cap stocks, and then emerging markets. And they did pretty well. They outgained, not by a lot, less than 1% on those two. Commodities had the biggest move. Let's zoom out here back to that Christmas level, and you can see how much they still have left to make up. So commodities are still lagging behind the most, hence the biggest gain. Emerging markets are actually break even now, so that's why they're not going up as much. And you can see bonds have really pulled back, and that's why they had such a bigger decline today. Let's take a look at some of these moves in these different asset classes. Starting with bonds, light pink shading, yellow line, very bearish short-term sentiment. So it'll be interesting to see if this ends up being trend changing short, because we're still bullish. We're still in bullish territory, and this is typically light pink shading, yellow lines, typically a bullish pattern. You also have, I would assume, let's take a look here, but I would assume we also have 3 red arrows on this, and you're pretty darn close. You should be. I guess it's saying that the moving average is down. There should be a red arrow there, but essentially 3 red arrows. And then you look at other oscillators, and you can see that you're down to the midpoints of these, but not really into bearish territory. So you're kind of at levels where you either bounce up or it's trend changing, right? To where now we might be in a bearish mode. If you take a look at the Euro US dollar, you can see that's a pretty good move. It's still, it's not a strong, bullish sentiment here on the short term. You're still in bearish territory in the intermediate line. You're still well below the moving average. I was going to show you this one. Here's TLT. So, you're still kind of at some very strong support levels here on bonds. And then the Euro US dollar, you can see, you're above the 17-day, but not by a lot. So it's not necessarily like bullish divergence here. We'll see if this continues a bearish convergence, right? When your MACD is below 0, but it's above its moving average. It's rising back towards 0. But doing so still below the 17-day moving average. So you're above it today. You're not really breaking through a range. You're barely getting above the 17. So let's see if there's some follow through on that here tomorrow. Here's the UUP in reverse, and very similar. They're still in bullish convergence mode here. If you take a look at gold, you can see gold sitting right around its point of control. All these moving averages are basically sitting right on top of each other, about as neutral as you could possibly be right now. On gold. And you saw some of the other asset classes, emerging markets, second day above the 17-day moving average. It's a very good sign. Bitcoin has been kind of in the news here, trading around that 50,000 level. Still well below its 8-day moving average, however, and flirting with its 200 and this volume node. Right, you get below that volume node, your next layer is down here to about 40,000, which would be well below the 200-day moving average. And still in a bearish trend. You can see the 8 and the 17-day have crossed below the 50, and now the 30-day is close to crossing below the 50 and the point of control. So you're kind of at this point right now in Bitcoin, again, as a reflection of speculative trading demand, kind of showing some risk-off mode here. Same thing with ARK. I mean, it's a good rally in ARK the last couple of days, but you're still below the 17-day moving average, and you're still below the 70% of the volume still above us. So it's hardly kind of making a recovery. It's more of you were so oversold, now it's just making an oversold technical bounce, and it's setting up for a divergence, and that divergence still could be either to the upside if it breaks above the 17-day, though you have a lot of resistance above you, or it could be a divergence back to the downside. I mean, you are in a death cross environment. The 30-day has crossed back below the 50, so we're kind of still in kind of bearish trending mode, and the last 2 days hasn't changed that. It's actually only just it's just it's oversold technical bounce is all we've gotten. You were so parabolic in that mode. It's hard to stay parabolic without some kind of retracement. Now the question is, do we get a new leg lower, or do we reverse the trend? And as of right now, you would still expect a new leg lower because of the trend, which put that together with Bitcoin, and also if you look at like XLK, which essentially is Apple and Microsoft, but XLK, look at Apple. Apple doesn't like with if S&P is starting a new bullish move right now, with that kind of breakout with yesterday's runaway gap there, and Apple is by far the biggest company, $3 trillion market cap. Microsoft 2.5, and then we go down from there. But if this does not look like it's a company that's starting a new move. It's a company that actually looks like it's ending a move, like it's gone parabolic right now, and it's about to kind of slow down, so to speak. And if this is what's driving the S&P, and this is not something you want to be slowing down right now if we're starting a new move. So it's a little concerning. Like usually the S&P kind of moves, you can see kind of hand in hand. If I were to, let me throw on, a comparison chart here. Comparison. And then we'll put on, oops, not that one. There it is, the S&P. So you look at like the last few times that we've gone parabolic. We went parabolic there, and you notice we went sideways for a good chunk of time. Well, we went sideways in the S&P pretty much for 3 expiration cycles as well. From right before July expiration to right before October expiration. The S&P had some ups and downs, but ultimately was sideways for three months after Apple went parabolic there. And if you go back to another period of time where Apple went parabolic last August, there you can see from that period we were flat for quite a while. Like we had peaked in September, and then we didn't go anywhere for a while. Now the S&P also kind of bottomed out, but you saw that Apple and the S&P both kind of started a period of volatility there, an intermediate decline in September and October, before a little bit of a run, and then a period of volatility in February and March, and then again another one in May there. The S&P kept going up to higher highs, but Apple was just still really volatile, and you can see volatile during this time with the S&P, and then now parabolic again, very similar to what we saw there. And could that have a detrimental impact on this burgeoning bullish move within the S&P 500? Of course, if you take a look at some of these other major markets that are out there, to see, okay, are we getting broad strength across the board? Japan certainly is. This is a good little rally, and pretty much what we're seeing so far is this kind of oversold technical bounces below moving averages. You got a good breakout finally on Brazil. Brazil is actually looking pretty positive for the first time in a while. Korea is actually looking pretty positive, and that's closely tied to the semiconductor index. Global economic growth expectations, but everything else still kind of looks just like oversold technical bounces. They're not really trend changing bounces yet, and so we're not quite seeing the broad, a new trend developing. Dark green shading and green lines are still red lines, along with these light green shadings here. Finally, let's take a look at the sector moves. Let's see the U.S. sectors. And you can see again, you have very good strength in XLK, but that's it. Like XL, you have also strength in utilities, staples, and real estate. And that's not, those three are only tied to XLK and safe havens. Here's your cyclical areas. And again, oversold technical bounces, but not new bullish trends quite yet in these areas. And they're actually more closely tied to the Russell 2000. So that's going to be the big key. Is this light pink green shading and yellow line going to turn into a bearish trade on financials and energy, as well as potentially materials and industrials, or are we going to change the trend and get back to a bullish one? That's obviously the big question. You see communication services, nice good rally today too, but it's also been the most bearish, and hence why it's rallying the most. All right, now for our trade idea of the day. We're going to follow a common theme we did with MasterCard. There's a lot of good stocks that have really sold off in this bout of volatility, but then they've bounced up pretty hard. And so we want to take advantage of this, as we did with MasterCard, and we'll do it here with Okta. If you notice, again, very oversold, strongly bearish, well below the moving average, 20%. But now, look at that, right back to the moving average, just like that. Good bullish bounce with a good strong near-term rally up above 90. You can see the bearish weekly candle we had is now no longer bearish. You got a transition candle there. So you have a rising differential, you have a rising PPO, you have a green arrow again. So a lot, I mean, they're not necessarily bullish signs that we're breaking out to the upside, but you can see we're not bearish anymore either. We don't have the light pink shading anymore. We are back up above the, back to the point of control, back into the value area with some bullish, back above the 17-day and really holding that 17-day pretty strongly there. Breakout. You can see the directional movement index. You know, the positive is well above 20. Your negative's not quite down yet. Give it another day at that trend, and it should get down below 25 here tomorrow. You look at the RSI and the CCI, and they were really bearish. Now they're in the upper halves of their charts, so that's a good sign for it. You look at the trend strength indicators. They had strong bearish trends. Now no longer. Right, we're above the blue line, still below the cloud, but at least we're not as bearish as we were. And then finally, if you look at the Bollinger Bands, we are back to the middle of the band. In fact, we're in the upper half of the bandwidth, with a bandwidth that's so high that's falling. And we're right around that point of control, which inside the value area, especially in this kind of, right in the middle, can act as a center of gravity. So what we decided to do here is say, okay, well, we'll take advantage of this volatility, especially considering that we're through earnings, and sell a put spread and a call spread on either side of the market, an iron condor spread, and get a pretty decent return. We only do one contract because it's $10 wide, so for about $600, which is 60% of my normal risk for this type of trade. We usually do about $1,000 of risk here. I can get a normal return, so I can get a good, actually better than normal return for much less risk than normal for this type of trade. And you can see my break-evens are pretty much right outside the range. So as long as we stay inside the value area here, then, which is 70%, right, one standard deviation, then we make our money because I got my break-evens pretty much on either side. So we get out of this. If there's a breakout, we'll get out and we'll lose 392. We're willing to lose 392. We can lose up to the $600, but we'll get out. Otherwise, if we just if that bandwidth starts to falter and we just go sideways, that's how we make money on this trade. We just stay in this area here. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's threads with, and let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel as well as our website at marketscholars.com. Click that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.